Welcome back to Macromotive, where we peel back the layers of global markets to reveal what's truly powering your portfolio. Today we're strapping in for a high-stakes showdown: AI stocks versus energy stocks in the back half of 2025. Imagine colossal server farms glowing like futuristic cities, nestled beside vast supertankers slicing through midnight oceans. Both engines, one digital, one elemental, are roaring to life. And the question burning on every investor's mind is this: which will propel your returns in the months ahead? The first half of 2025 felt nothing short of seismic. AI powerhouses such as Nvidia, Microsoft, and Adobe shattered forecasts. GPUs remained sold out. Cloud subscription growth exploded, and earnings calls were laced with talk of exponential adoption across finance, healthcare, and logistics. The market's once skeptical murmurs faded as margins expanded and moonshot valuations became grounded in real-world usage. Meanwhile, the energy complex wasn't to be out. Crude prices fluctuated between $70 and $80 a barrel, supported by OPEC discipline and steady global demand, while natural gas hovered in the $4, $5 MMBTU range, with winter anxieties echoing through. Energy giants like Exxon and Schlumberger returned to their classic form: robust earnings, solid dividends, and infrastructure playbooks that offered stability absent from many high-flying growth names. Yet beneath their disparate facades, AI and energy share a common narrative. Both are balancing growth with resilience. AI stocks carry electrifying growth potential, but they also bear the weight of steep valuations. Many trade at 30 to 50 times forward earnings, and any misstep in execution or regulatory backlash could trigger sharp reversals. Conversely, energy equities lean on dependable cash flow and attractive dividends. Exxon's roughly 3.3% yield is no small draw, but remain tangled in commodity cycles and geopolitical risks that can pull their rug from under them overnight. Dig deeper, and the forces driving these sectors are stark. In AI, the hardware race to fulfill enterprise demand is only intensifying. Microsoft's Azure and Amazon Web Services lead aggressive rollouts of GPU-backed AI services. Internal margins soar, and boardrooms allocate ever larger budgets to deploy automation, predictive analytics, and language models. It's not pure buzz, measurable impact. Workflows are accelerating, productivity gains are stacking up, and AI is proving to be a believable profit driver, not just a tech trend. In stark contrast, the energy thesis is anchored in real assets and global infrastructure. Dividend yields alone beckon income-focused investors, while equipment and service providers like Schlumberger stand to gain if the oil patch revs back to life. Midstream players, pipeline operators like Williams and EQTG, creating recurring revenue regardless of commodity price swings. The result, a part of the energy story remains insulated against the kind of valuation froth that grips tech. Of course, both narratives harbor significant risk. In the AI arena, valuations could become unsustainable, and regulatory or data limit reforms already gaining bipartisan attention could throttle expansion, grid capacity constraints, and flashy headlines of server farms. Overwhelming local utilities have started casting subtle whispers of caution. Alternatively, in the energy sector, any demand dip, say from a global recession or clean energy policy, and even if drilling slows and gas pipelines lag behind demand, political decisions like subsidy rollbacks or climate-related restrictions could suddenly reshape growth expectations. So what should savvy investors do? As we enter the second half of 2025, it strikes me that compartmentalization is the enemy. Here, this isn't about choosing a side, but about strategically blending them. Imagine a portfolio with core anchors like Nvidia and Microsoft, balanced by Fort Knox like energy hold positions, Exxon for dividends, Schlumberger for equipment, upside, and Williams for midstream cash flow. For the upside seeking, a handful of fast-growing AI applications can add high-growth exposure. For the yield-focused, oilfield services and pipelines offer reliable returns. Channel your inner tactician. Lean into AI following strong earnings beats, or overweight energy amid OPEC announcements or commodity-driven inflation spikes. To balance volatility, consider callers on expensive AI names or covered calls on blue-chip energy plays. As 2025 pushes forward, the bear case for both sectors is worth acknowledging. A sudden global slowdown or spike in interest rates could slam growth assets and commodity demand. Alternatively, an aggressive regulatory clampdown on AI might deflate valuations, while climate-focused policy shifts could squeeze fossil fuel investments. The smart move: embrace flexibility and equip your portfolio with both growth engines and income machines, adjusting your tilt depending on macro triggers, be it GDP shifts, interest rate pivots, OPEC, or key earnings revelations. At Macromotive, our mission is to illuminate these underlying forces, not just tick off stock picks, but help you understand the geopolitical, technological, and financial gears that power them. So tell us, are you ready to ride the AI-driven rocket, or anchor your returns and energy yield? Or perhaps most intelligently, will you strike a deliberate balance and rotate tactically between the two? If this exploration into AI and energy investing sharpens your thinking, hit like, smash, subscribe, and ring the bell. That way, you'll stay ahead of every macro trend that could move your money in a massive way. This is Macromotive, where we turn big picture market moves into smart action.